Okay, let's unpack this. If you are tracking the oil gas sector today, especially, in the Middle East, the whole mainstream conversation is stuck.
Completely stuck. It's all macro geopolitics.
Pipeline skirmishes, diplomatic shifts, OPEC quotas. But we are tuning all of that noise out to focus on a single ticker, Gulf Keystone Petroleum, or GKP.
Right.
Our mission right now is to drill straight into their financial documents to find out what is actually driving the stock beyond the headlines.
And what's fascinating here is that the general chaos is, well, it's a distraction from a hyper-specific, almost binary event hanging over this company.
Okay.
It's not just oil volatility, it's an independent financial audit. The outcome of that audit dictates, well, everything you need to know about GKP.
It decides everything.
It will decide definitively whether this stock is about to unlock a massive trove of cash or if it sinks into a deep regulatory quagmire.
Exactly. This is pure micro-risk, micro-reward. So our mission today for you is to walk away with a 360-degree view. We need to connect their balance sheet, their operational metrics,
Which are exceptional.
directly to that unpredictable geopolitical risk, and most importantly, this single crucial audit.
Let's do it.
So let's jump right into that core catalyst, the one thing driving all the market volatility, the ongoing independent audit. Gulf Keystone is waiting for results that could unlock a jaw-dropping $151 million in historical arrears. I mean, that's a staggering sum.
It is, and we have to break that number down because it's not all the same kind of money. It's split into two pots.
Go on.
You have about $120.4 million designated as cost oil, and then $30.7 million as profit oil.
And for you listening, what's the difference there?
Well, think of cost oil as GKP just getting back the money they've already invested.
Yeah.
The CapEx, the day-to-day running costs.
So reimbursement.
Exactly.
Yeah.
The profit oil is the actual revenue, the net earnings after all those costs are covered. And this entire payment hinges on the KRG and Baghdad agreeing to verify those costs.
Through this third-party consultant.
Right. If they disagree, that $151 million just vanishes or gets slashed. But wait, look at this crucial silver lining that I think everyone is overlooking while they obsess over the audit risk.
Okay.
The company has secured renewed interim export agreements, and those are rolling right into 2026.
So there's operational stability?
Yeah.
Pipeline access?
Yes, they have a path to sell their product while they wait for the audit result.
That continuity is massive. If the audit comes back favorable, the combination of that cash recovery plus their current robust production, well, that means cash acceleration.
And that operational reality is the key fundamental strengths here. We're talking about production running very, very high.
How high?
They hit a stellar 47,900 barrels of oil per day, or BOPD, in December. That's a huge output, a massive jump from their H1 average.
But I have to push back on that just for a moment. Wait, isn't that high 47,900 BOPD figure almost irrelevant if the physical pipeline, the Iraq-Türkiye pipeline, relies on a political truce that could just break down tomorrow?
It could.
What good is high production if they can't physically export it?
That is the core tension, you're right. But the audit helps answer that. If the audit is favorable, and they maintain that output, the market gains confidence that the geopolitical risks are manageable. And most importantly, it locks in a massive jump in their netbacks.
Netbacks. Can we define that quickly?
Simply put, it's the price they actually get per barrel after all costs are out. Transport, operations, royalties, everything.
And when they were forced to sell locally?
Their netback was terrible, around $27, $28 a barrel. The export resumption and a validated audit mean that leaps up to around $52 per barrel. That's where the real opportunity is.
So the tension remains. A favorable audit plus new export deals means massive cash. An adverse finding could gut their claims, regardless of that impressive output.
That's the tightrope they're walking.
Let's shift now, diving deep into the structural health of GKP beyond this one audit. As a fundamentalist, I have to say, this company is built incredibly well.
Oh, it's solid.
They are completely debt-free. They are sitting on $100 million in net cash, and that is after paying out recent dividends.
And that cash isn't just a number. It's their geopolitical insulation.
Mm-hmm.
That buffer lets them survive delays or shutdowns without having to panic.
And the efficiency is it's world-class for the region. Their operational expenditure, their OPEX remains so low.
Just $6 a barrel.
Think about that. They spend $6 to get a barrel of oil out of the ground. It supports incredibly strong free cash flow.
And that's reflected in their production. Output improved steadily from the first half of 2025, which averaged around 44,000 BOPD, right up to that critical December rate.
Right, and that robust performance helped their H1 2025 revenue. It rose 17% to $83.1 million. But, and here's the context we can't forget.
The margins.
The margins faced extreme pressure from those local sales at that, $27 realized price?
And that historical low margin is precisely what makes the current state so exciting. The export resumption means that realized price jumps from $27, $28, all the way up to around $52 per barrel.
That's a game-changing netback improvement.
It instantly converts that high production into serious profits.
That pricing lift is a structural tailwind you just can't ignore, and it seems like management knows it.
Oh, they absolutely do.
Yeah.
The CEO, John Harris, called 2025 a milestone year.
Yeah.
Because of the export restarts and the payments they received. Their focus isn't just on surviving the audit.
They're planning to thrive.
Exactly. They're in constant talks with the KRG for arrears, and they're prepping for field expansion, including water handling upgrades.
But let's look at the CapEx guide. They are spending money. Net CapEx is guided at a tight 30 to 35 million for 2025. Is that brave or foolish to commit that money during such high political volatility? That spending is only validated if the audit is good and the pipes stay open.
It signals internal confidence. They wouldn't be committing that capital if they thought the operation was about to collapse. And the market is reinforcing this.
How so?
We've seen an active share buyback program. They even explored an Oslo dual listing, which is a clear signal they want to enhance liquidity and, broaden their appeal globally. Shareholders are clearly accumulating ahead of the audit news. So, this raises the really important fundamental question that you, listening right now, need to wrestle with.
What's that?
Is this incredibly strong operational efficiency, the debt-free status, the $6 OPEX, and this huge pricing lift to $52 a barrel, is it enough to offset the geopolitical risk and the historical tensions between Baghdad and the KRG?
That is the ultimate test. And it brings us directly to our impact analysis. When you look at all the evidence, is GKP a classic value trap?
Waiting for the next shoe to drop.
Or is this truly a once-in-a-decade entry point for a well-run, debt-free producer?
Okay, let's connect all these data points. The bull case is highly specific. It relies on both political and operational stability. Let's look at the numbers.
Lay it out.
First, just the sheer cash flow potential. Renewed exports plus a favorable audit unlocking $151 million that directly fuels dividends and expansion. Real money in your pocket.
Right.
Second, the valuation. This low-cost production at nearly 48,000 BOP gives you a healthy projected dividend yield of 10.5% and an attractive forward PE ratio of just 6.1.
And a PE of 6.1 for a successful debt-free producer that signals extreme market skepticism. It's either a huge bargain or a massive warning sign.
Precisely. And that skepticism fuels our third point.
Yeah.
Takeover whispers. The market sees how cheap it is. Analyst consensus is holding a firm buy rating with price targets implying what, a 47% upside?
Towards GBX 257.
And we keep coming back to that crucial debt-free balance sheet. It enables growth in this stable $70 Brent environment. That's the whole upside scenario.
Okay, now, as fundamentalists, we have to pivot hard to the bear case, because the risks here are just as specific and they can materialize overnight.
Absolutely. Number one risk, geopolitics. A pipeline shutdown isn't a theory, it's a historical reality for them. That would halt that $52 realized price instantly.
Forcing them back to those low netback local sales.
And wiping out profitability. Then there's the second major risk, the audit downside. That consultant could slash the claim or reprice the barrels lower. That doesn't just hurt cash flow.
It destroys confidence.
It destroys confidence and erodes that $100 million cash buffer fast.
And we have to be honest about the historical baggage, right? The company is cheap for a reason.
You're right. You still see signs of that instability. Overbought shares combined with a negative PE, which reflects past losses. The market hasn't totally forgotten. Plus, the wider Kurdistan debt overhang could erode their leverage.
And the fact that consensus EPS cuts are still signaling decline or uncertainty shows that skepticism is still very high in some parts of the market. It's what's keeping the stock price down.
It is.
So what does this all mean when we put the two views together? The complexity for you is that the entire investment thesis rests not on the strength of the asset or the balance sheet, which are fantastic,
Fundamentally sound.
but entirely on the outcome of two specific non-financial events: the audit results and the long-term stability of that Iraq-Türkiye pipeline.
So, to recap the core tension we've explored,
Yeah.
you have this massive demonstrable operational upside, 48,000 bopped, 100 million in cash, $6 OPEX,
Incredible number.
pitted directly against a single point of failure. The audit and the geopolitics needed to monetize that oil.
So, with this mix of massive upside and these very specific risks, the outcome of a third-party audit and those fragile export agreements, we have to ask you directly, has your thesis on GKP changed now that you see the numbers behind the headlines?
And here's where it gets really interesting, building on those market whispers we mentioned. The broader market appears to be significantly underreacting to two things at once. The renewal of those interim export agreements and the full potential of this audit to validate $151 million in cash, all while they are pumping at this incredibly high rate.
So if the news is favorable.
If the news is favorable, the resulting surge in cash flow and dividends could far outweigh the current known geopolitical concerns.
The ultimate question for you then is whether the risk of waiting for that binary audit result is worth the potential cash flow reward. We've laid out the facts you need to decide.
Thank you for joining us for this deep dive.